Welcome to the Trendline Gala podcast. Today, we are tackling a topic that is just absolutely crucial for anyone even thinking about getting started in trading. We're talking about the humble but really powerful trading rule.
And this is a discussion that's really tailored for you, the learner. We're focusing on the absolute basics of safety in the markets. Our mission today is all about setting up the parameters for protection, for capital preservation.
That's right. Because for a beginner, the immediate goal when you start trading is not to guarantee profits. I mean, nobody can guarantee those.
No.
It's to set up effective boundaries. This structure, it's what ensures that your pursuit of knowledge and learning doesn't lead to these huge, unnecessary financial losses.
It really is. We're looking at the system that lets you stay in the game long enough to actually learn what you're doing.
The essential groundwork.
It is, yeah. It's the groundwork for financial longevity. If you're just getting started, you have to understand that the system you set up, it must be designed so that when things inevitably go wrong,
And they will.
they absolutely will, in any market. The damage has to be capped, controlled, and, well, survivable.
Okay, so let's break this down. A lot of people new to the markets, they think trading rules are these, like, complex formulas.
Right, algorithms.
Yeah, or some secret for predicting exactly where a stock is going to go next. They're always looking for that perfect combination of indicators that's going to signal a guaranteed win.
They confuse a trading plan with a crystal ball.
Oh, boy.
They put, 90% of their energy into figuring out the perfect entry point. They think the rest just sort of takes care of itself.
Exactly. They hunt for that secret entry signal. But the truth is, the most important rules, especially for a beginner, are really just controls over your own behavior.
Mm-hmm.
These rules aren't designed to forecast the market. They're there to limit the damage when the market, inevitably moves against you.
And this shift in perspective is just so crucial. You have to treat trading like a serious business.
Not a hobby.
Not a hobby, not a lottery ticket. Every single successful business needs a systematic approach, clear risk management, and fundamentally a written plan. That plan, it eliminates so many of the biggest causes of failure for new investors.
And those failures almost always come from emotion, right?
Inconsistency and emotional decision-making. Absolutely.
The beauty of a system is that it takes the pressure off of you, the trader. The accountability is on the plan itself.
That's it.
So when something goes wrong, the question isn't, why did I fail? It's, did I follow my plan?
Precisely. Let's really hammer home this idea of rules acting like guardrails.
Okay.
So imagine you're driving on a winding mountain road. The guardrails along the side, they don't give you a map. They don't tell you the best speed for the next curve or where you're going.
They don't help you drive better, necessarily.
Correct. Their job is singular. They just stop you from going too far off course and, falling into the ravine when you misjudge a turn or hit an icy patch.
They're just passive protection.
That's all they are.
So the trading rule isn't, this stock is definitely going up 5%, so I have to buy it now.
No.
The real protective rule is something like, okay, I'm in this trade. If the market moves against me by this specific amount that I've already calculated, I am out immediately. No questions asked.
That's the difference. That's the difference between just guessing where the road goes and proactively managing your risk for when the unexpected happens. The rule dictates the exit. It protects your capital from a total loss.
Okay, so as we move into the specifics of risk, let's look closer at this part, the very nature of markets. We have to reinforce a core truth right from the start. Markets are uncertain, inherently uncertain. You will never, ever find a rule or a strategy that completely removes that uncertainty.
It's impossible. That uncertainty is the engine of the market. I mean, if everyone knew what was going to happen, there'd be no volatility. And with no volatility, there's no opportunity.
And the higher the potential return, with things like emerging market stocks or active trading, the risk just shoots up exponentially.
Right. It does. And managing that risk is the only sustainable path forward, which leads us right back to our main point.
Which is?
Rules control the trader, not the market. They control what you do and when you do it. By spelling out your entry, your exit, and your risk management beforehand, you remove all that subjectivity. You take the emotion out of it.
Because if you don't define those actions before you're in the trade, you just end up reacting. Right.
Completely. Your decisions change from one moment to the next. A sudden drop causes fear, you sell at the worst possible time. A sudden spike causes greed, and you hold on way too long, only to watch it all crash back down.
Right. And written rules are stable. They exist outside of that immediate emotional mess.
Exactly.
So this brings us to what we could call the beginner trap. Why do so many beginners lose money? It's often not because they're wrong on every single trade idea,
No, not at all. They might be right half the time.
but their losses are just not limited.
That is the disaster factor, the lack of limitation. Let's talk about the math here for a second. Without those boundaries, those financial guardrails, small losses just spiral into huge ones.
Right.
Say you have $10,000 to trade. You make some good trades, you gain 10%. You now have $11,000. Great.
But then you get impulsive on one trade. You ditch your plan.
Exactly. And you lose 10% of your entire portfolio on that one bad, uncontrolled trade. So now you're down to $9,900, you've lost your gains and some of your starting capital.
And to get back to your starting 10,000, you now need to gain more than 10%.
More. If you lose 20%, you need a 25% gain just to get back to even. If you lose 50%, you need to double your money. A 100% gain just to get back to where you started.
The losses compound so much faster than the gains.
That is the brutal reality of unlimited losses. One bad day, one single bad day driven by impulse can just wipe out the gains from many, many good days.
So trading without boundaries isn't flexibility.
It is pure exposure. You're just exposed to way too much risk, and your decisions become reactive instead of planned.
And there's an emotional cost to that, too. Impulse, fear, greed. These are powerful forces. They can cause a trader to just completely abandon their system. And that's where you don't just lose capital, you lose confidence. And that leads to burnout and then quitting.
And here's what we know. It's been reported that more than 80% of day traders give up and quit within just 2 years.
Wow, 80%?
Yeah, it's a sobering statistic. It just highlights that success here isn't about finding the perfect stock. It's about emotional control and financial endurance. And that endurance comes directly from capping your losses.
We should probably also stress the seriousness of these risks, especially for something like day trading.
We have to. Day trading is extremely risky. Before anyone even considers it, you have to be prepared to lose all the funds you allocate to it.
All of it.
All of it. It requires deep knowledge, discipline, and, well, serious psychological resilience. It's just not appropriate for someone with limited resources or a low tolerance for risk.
And this is so important. You should never, ever fund this kind of activity with money you need.
Never. We're talking about retirement savings, student loans, emergency funds.
Yeah.
If you are trading with money you can't afford to lose, you will trade from a place of crippling fear. And that guarantees you'll break your rules.
There's even a rule about this, the pattern day trader rule.
Right, the PDT rule in the US, it's a perfect example of the system recognizing this risk. A pattern day trader is someone who makes 4 or more day trades within 5 business days.
And once you're labeled a PDT,
You have to maintain at least $25,000 in your account at all times. If you drop below that, you can't day trade until you get back above it.
so that 25 grand is a cushion.
It's an institutional guardrail. It's a buffer. The system is basically putting up a warning sign about how volatile this activity is.
So the goal isn't just to learn how to trade, but how to trade safely, so you don't run out of money before you figure things out. So now that we get the consequences of trading without boundaries, let's walk through this. If rules are all about limiting damage, what do those protective rules actually look like for a beginner?
We can break them down into 3 main categories, really. There's avoidance, financial caps, and what you could call behavioral stops. They're all focused on loss prevention.
Okay, let's start with avoidance. Rule type 1. When not to trade. This probably sounds a little weird to someone who's excited to start trading. A rule to keep them on the sidelines.
It does, but some of the most important trading rules are the ones that focus on avoiding trades altogether. It's a form of risk control called risk avoidance. The best trade you ever make might be the one you decided not to take.
So what are the specific conditions we're trying to avoid here?
It's all about avoiding situations where you're physically or emotionally compromised. This isn't about the market, it's about your own cognitive performance. So a rule should say you will not trade when you are really tired or distracted, rushed, or feeling emotional.
And that emotion could be stress, or even euphoria from a big win.
Exactly. Or frustration from a loss. And crucially, it includes not trading if you are unsure why you're taking the trade. If you can't write down a clear reason, just don't do it.
Let's use that everyday analogy, the one about driving a car.
Yeah, it fits perfectly.
Yeah.
Even the most skilled professional race car driver has a firm rule to avoid driving if they're severely tired or emotionally compromised. The risk of a crash is just too high when your decision-making speed is shot.
You're actively choosing to manage risk by just avoiding the whole scenario.
That's it. So now that we know when not to trade, let's talk about how much risk to accept when we do trade. This is rule type 2, limiting financial loss, capping the mistake. So your protective rules must define, in concrete terms, how much money you can lose on one single trade and what your total acceptable loss is for the day or the week.
And the whole point of these rules is just to make sure that one bad position or one bad day can't cause catastrophic damage to your portfolio.
Right. It doesn't guarantee a win, but it absolutely limits how bad a mistake can get.
So how does a beginner actually enforce this?
This is where you use a mechanical tool, primarily the stop-loss order. A stop-loss is just a clear, predetermined price level that you establish before you even get into the trade. You're telling your broker, if the price of this thing drops to X, sell it immediately.
Which means the plan dictates the exit, not the panic you feel when the stock is crashing.
Precisely. You decide how much you're willing to risk in dollars when you are calm and rational, not when the market is moving against you. This is the foundation of position sizing.
So let's explain position sizing in simple terms without giving specific formulas.
Oh, okay. It's about calculating how many shares you can buy so that if your stop loss gets hit, you only lose a preset amount of money.
For example, if I have a $10,000 account and I decide my maximum risk on any single trade is $100.
Right, just 1% of your account.
So I have to figure out how many shares I can buy so that if my stop loss is triggered, I only lose that $100.
Exactly. So if you calculate that the distance between your entry price and your stop loss price is $1, you can buy 100 shares. If it's 50 cents, you can buy 200 shares. Your risk is always fixed at $100. You are controlling your exposure.
The damage is a small, manageable bruise, not a fatal wound.
That's the goal.
This whole process sounds a lot like a physical safety analogy, like wearing a seatbelt or a helmet.
It is the perfect analogy. A helmet doesn't help you win a bike race, right? A seatbelt doesn't predict a crash. Their purpose is pure damage control. They're there to reduce how bad the damage is when the crash happens. A losing trade is the crash. The stop loss is your helmet. It lets you walk away instead of ending your trading career.
So if the first two rules cover when to trade and how to cap a single mistake, the third rule deals with a huge psychological challenge. Rule type 3. Stopping after losses.
Yes. This one is all about preventing what's often called revenge trading.
That's when you try to win your money back immediately after a loss, right?
Exactly. It's driven by a powerful cognitive bias called loss aversion. The pain of a loss feels roughly twice as intense as the pleasure of an equivalent gain.
So losing $100 feels way worse than winning $100 feels good.
And that feeling drives you to do rash things. You feel this urgent need to reclaim what you lost, so you double down, or you take a huge position on a gut feeling, and you just compound the first mistake.
So the rule here has to be really concrete.
It's non-negotiable. You have to have a rule that requires you to stop after a certain amount of total loss for the day, or after a certain number of losing trades in a row.
So something simple like, if I hit my daily risk cap, I am done trading for the day.
Or if I have 3 losing trades in a row, I close my platform and walk away. The benefit is creating distance. You interrupt that emotional feedback loop. You force yourself to cool down before you risk any more capital. It's the ultimate tool for behavioral loss prevention.
This episode is sponsored by TrendlineGala.com. Quiz your way to financial mastery.
So now we move from the rules themselves to the critical idea of discipline. A great plan with amazing risk management is, well, it's only as good as the discipline of the person who's using it.
Sticking to the plan is everything.
It is the critical, non-negotiable point of execution, especially in active trading, like day trading, where things happen so fast, there's just no room for second guessing.
So if you deviate even a tiny bit, like you move your stop loss down just a little, hoping it'll bounce back,
that's where the loss can become immediate and severe. It can multiply before you can even react. You have to train yourself to be disciplined, to treat the plan as sacred.
which brings us to why these rules absolutely must be written down, not just kept in your head.
When you're calm and relaxed, planning your trades on a Sunday afternoon, your rational brain is in charge. But in the heat of a trade, when the market's moving against you, the primitive, emotional parts of your brain take over.
Fear and greed.
They're incredibly powerful, and if your rules are just in your memory, they're subject to change under that stress.
Right. Your mind will come up with an excuse to break the rule. This time is different.
It's about to turn around. But written rules are stable. They are objective. They're a contract between your calm self and your impulsive self. You can only review and improve them when the markets are closed, not in the middle of a trade.
So treating trading as a business isn't just a metaphor, it's a requirement.
It is. A successful business doesn't change its policies during a crisis. It follows its standard operating procedure. A trading plan is that procedure.
And the commitment to consistency is the discipline needed to run that business.
Right. Let's use an analogy from professional sports.
Okay.
Think about a professional basketball player. They're incredibly talented, but they still have to follow the rule that they cannot step out of bounds. They follow it not because they might fail, but because the structure of the game requires consistent boundaries.
So the rule is the boundary of the game. If the market is the game, your plan is your boundary.
Exactly. Discipline means you follow your written rules consistently, even when they cost you a potential gain sometimes.
And that's a tough one for beginners. They might break a rule, they might cancel a stop-loss order right before it hits, and then watch the price rebound. And they feel rewarded for breaking their rule.
And that is the most dangerous psychological trap. If you break your rule and it works out, you've just taught yourself that the rule is optional. You've reinforced the bad behavior.
Because the next time you break that rule, it might lead to a devastating loss, and you've got no system to fall back on.
That's it. The goal is to survive long enough to capitalize on the times you are right. Discipline ensures your losses stay small enough that your wins are meaningful.
Okay, let's look closer at this part. Journaling. For a lot of beginners, journaling seems like, optional homework, something you do if you have time.
Right.
But if we're treating this like a business, journaling has to be a mandatory control rule, just as important as a stop loss.
It's the data collection and performance evaluation part of the business. Without objective data, you can't review and you can't improve your process.
So what does a simple mandatory journal look like? It doesn't need to be complex, right?
Not at all. A simple journal records 3 essential things about every single trade, win or loss.
First up is the entry.
First, you write down why you took the trade. The exact reason, the logic. If you can't write down a clear reason, you shouldn't have been in the trade.
Okay. Next is the plan.
Second, you record the original plan. What was your preset stop-loss price? What was your profit target? This sets a benchmark for your execution.
And finally, the outcome.
Third, you write down what actually happened, the gain or loss, and, this is the most important part, any deviation from the plan. Did you move your stop? Did you exit early out of fear? Those deviations are the critical data points.
And this turns trading from, just reactive guessing into a structured process you can actually review.
That's it. You go from saying, I just got unlucky, to I deviated from my risk rule because I moved my stop.
That review process is what lets you identify patterns in your own behavior. It shows you your strengths, but more importantly, it shows you where you need to improve.
Without those records, mistakes will just repeat over and over again without you even noticing them. You won't know if your strategy is bad or if you're just failing to follow a good strategy.
So if my journal shows I'm losing because I keep breaking my rule about stopping after 3 losses, that's a discipline problem, not a strategy problem.
Exactly. And the journal is the final step in risk management because it helps you reevaluate your risk tolerance based on facts, not feelings.
How does that data feed back into the protective rules we talked about?
Well, you can look at the data, your win rate, your average win amount, and your average loss amount. If your average loss is way bigger than your average win, you know immediately your stop losses are either set wrong or you're not enforcing them.
So that information allows you to adjust.
You can adjust your position sizing, your risk management, all to keep those losses small and controlled. It turns the chaos of the market into a manageable, data-driven feedback loop.
So to summarize our discussion today, the main theme is actually pretty simple. Trading rules are not some kind of magic key to predict the market.
Not at all.
They are essential tools for capital preservation. They are the controls you build into your process to limit damage, slow down your impulsive decisions, and make sure you maintain discipline.
If you take away just one thing, remember that you have to be proactive. Identify the potential downsides, decide what your maximum loss is, and accept that risk in advance. Write it down before emotion has a chance to take over.
If you're a beginner and want to practice building safe trading rules, you can take our free beginner trading quizzes at TrendlineGala.com and learn how rules fit into the bigger picture. Next time, we'll talk about how emotions like FOMO and revenge trading can quietly break even good rules.
And that's a crucial next step, because even though practice trading is helpful, it doesn't really prepare you for the emotional pressure of having real money on the line. And that's why the written plan is so critical. It's your defense against your own psychology.
Thanks for joining us at Trendline Gala.